All right, good evening, everyone. Welcome to the Employable Accountant Cohort 1. I believe we are excited to be here this evening. Please let me see your excitement. Just react with your favorite emoji. All right, thank you, Tail, Divine, John C. Thank you. All right, thank you, Taiwo. Yeah. All right, so my name is Joy Uri, and I am the lead facilitator for this training. So I'm going to be taking you through the 7 days on the practical accounting training. So I believe that we are all ready. We are here with an open mind to learn and to grow as well, because from the survey we took, we noticed that majority of you are students, and you there is this passion that you want to learn, and I believe you came with that mindset this evening. So we'll just without wasting much of our time, because this training today's one we are going to be spending an hour. So subsequent training, we also try to make it short and not overwhelm you with lot of information, so you can go back and reflect on what you have been taught about after every session. So meet your trainer, the facilitator for this training. So like I said earlier, my name is Joy Huri, and I'm the lead facilitator for this training. I'm a financial reporting and tax specialist. You can connect with me on LinkedIn, Joy Huri. I believe a lot of us are on LinkedIn. So I would like us to be reacting. I want it to be an interactive class. If you are on LinkedIn, let me see your emoji. I believe a lot of us are on LinkedIn. And if you are not yet on LinkedIn as a student, or you are a recent graduate, you are a working accountant, you need to create an account and be in that space, because that's an avenue for you to learn. You learn from top accountants, those in your profession, so you connect with people and also learn from them. So if you are not yet in that space, please ensure you create an account. I believe we got that. So you can react using the emoji, or you can type on the chat box. All right, thank you. So we have some rules that will guide us in this webinar, just to help us work with time and also ensure we are able to achieve a lot. It's just to help us work with time and help us achieve a lot. So the first rule, as we can see on the webinar on the screen, I hope you can see my screen. Please let me be sure about that you can see my screen.
Yeah, we can see your screen.
All right, thank you so much. So please, whenever you sign in, or whenever you join the call, keep your video off and your mic should be muted, unless you are asked to speak or you want to ask a question. And there will be time for question after every session. So, and also avoid distracting the webinar with background noise. So I know some of us might join a meeting, maybe rushly, and we might forget to turn off mute our mic. So, and if there is a noise, a background noise, I expect every one of us to please check our mic to know where the noise is coming from. Thank you so much. Then all questions should be penned down. If during the training you have any question, anything you are not clear about, you can drop it on the chat box. I'll try as much as possible to be checking the chat box, and or you can pen it down if you want to express yourself. So there will be a time for you to speak and ask questions. So you can pen it down. After this session, you'll be given the opportunity to ask question. And also, Please come prepared with a notebook, a notepad, pen, and if you have a laptop, it's not compulsory, but if you have a laptop, you can also and ensure it's there's a Microsoft Excel because that's what we'll be working with. So ensure it's installed and some of us might be like, okay, what of us that don't have laptop? So this training, we have a YouTube channel. It will be recorded and it will be available on our YouTube channel. So you can watch it subsequently and be able to practice. Then, but that does not mean you should not join class. I always advise people to join classes so that you'll be able to ask questions because when you're watching on YouTube channel, you might not be able to ask questions. It's not even you might. You cannot ask question. So it is advisable you join the class so that you'll be able to ask questions where you are confused and you need clarity. I hope we understand this rule. Please let me hear from you. I hope we understand. All right. Thank you,
Yes,
Tolu.
ma'am.
Thank you so much. Thank you, Johnsy. Thank you, Yomide. So moving to the next slide. So just a word of advice for us. Um, let's always take notes whenever we during every session. Let's take notes. I it's something that actually helped me that have been helping me whenever I take go for trainings. I take notes. So this is not just one random training. It's also it's an avenue for you to learn. So let's endeavor to take notes during every session and let's stay committed. Let's not be if you are opportune or you have the chance to be in class, please let's stay committed throughout the entire week and so we can ask questions and also lastly focus on learning and not just attending. So you don't just want to come and mark attendance, you want to really know what is being taught. So if you are confused, if you have there's no wrong question. If you have any question, you are not clear about anything, please ask your question. If you are not clear, forget about what your neighbor will be thinking or anything. Just ask your question. If you are not clear about anything, if you don't want to speak, you can type on the chat box. So remember, the goal of this training is not just to gain knowledge but to develop practical skills that will make you a more employable, valuable accountant. So the goal of the employable accountant is to train students, recent graduates, and any accountants, working accountants that are finding difficult to really understand what the accounting system is about. So you want to make yourself employable even before you leave school, even before you finish your NYC, your service, and also even in that place that you are currently working, you want to be able to give financial advice and all to your employer. So that's what this training is about. So when you are coming out from school, you are not coming out with just theoretical knowledge. You know what is expected of you as an accountant when you go hard there. So that's what we are yet to achieve and what we aim to achieve actually. So we wish you an exciting and impactful learning experience throughout the training. So moving on to the next, you can connect with us on our social media platform. So we have a WhatsApp channel, we have a YouTube channel. So I expect us to subscribe to our YouTube channel as we are going to be posting even after the training, after the webinar, we'll be having subsequent videos that we'll be sharing there. So I expect every one of us to go to our YouTube channel, subscribe, like, and share to your friends and loved ones, anyone in the accounting space that you know that is currently not in this training. So far I hope we understood. I hope I am not alone and I hope we are getting all right. Thank you so much. So, what we are going to be learning from this webinar, there are 7 days, and we'll try as much as possible to cover a lot, something that will help you stay your ground, stand your ground, even after school, as a recent graduate, and even as a working accountant. So, these are what we are going to be considering in this webinar for the next 7 days. So, for today, we are going to. Do we have any questions so far? Let me, before I move to the class, the lecture for today. Do we have any question? All right, we are good to go, right? Please.
Yes, we are good to go.
All right, thank you so much. So, today we are going to be looking at simplifying what accounting, bookkeeping, double entry principle is about, because this, I believe, is the foundation for every successful accountant. If you want to be successful, you need to know these basics. You need to understand these basics. You need to understand the double entry principle, what it entails, that at any point in time, if they wake you up, you'll be able to say, oh, okay, I'm to debit this, I'm to credit this. That's what accountant, you debit. So what's the rule again? Let me know if with a lot of us are students here. So what's the rule? You can type it, or you can, if you want to speak. The rule on double entry principle. So who is giving us answer to that? All right. So it's debit the receiver, credit the giver.
Debit and credit.
Yes, debit the receiver and credit the giver. So it's still very much applicable in practice. It's very much applicable in practice. So now, what accountant in brief, in summary, is a language of business. So every business, they want to know if they are doing well, if they are making profit, if the business is going to be sustainable for a long period of time, or if they are borrowing much, what do they own as a company, what asset do they have, and what are they owing people outside. So this accounting is is what tells a business, or the manager of a company, all of this. So in brief, accounting is the language of business. It tells us how much a business earns, which is the revenue, what is coming in, how much it spends, what is it spending on, what are the expenses that the business is spending most of its fund on. It also tells us what a business own, their assets, and also tells us the liabilities they have if they borrow loan, or they have any other short-term liabilities. And it also tells us if a business is making profit or is making a loss. So this is accounting in brief. So it is a department in every organization that is very important. It's very important. Is a crucial department in every organization. So that's why when you are talking about different organization in different departments in an organization, the finance department is a major department there. So we have the sales department, the finance department, the human resource department, and so on. So accounting deals, or I'll say accounting interact with every other department. Please, Victor, please can you mute your mic? Thank you. Please can you mute your mic, Victor? Victor, please mute your mic. Thank you. All right, so that is accounting in summary. I believe we got that.
Yes.
All right, thank you. So the now we were taught in school accounting is the process of recording, interpreting, and recognizing all of those many process. Yes, those process are there. They are actually there. The first stage of accounting is you recording. If there's no record, there is no interpreting. If there's no record, there's no communication. So you have to record first before any of those final aspect, which is the interpretation or communication, comes in. So the first process is your recognition, which is recording. So when you make sales, as an accountant, you are supposed to record it either manually or through an accounting software, right? Or when you make any expense, you are meant to record it manually or through an accounting software. So the first process in accounting is recording. You have to record if you really want to know the true financial state, or if a company is profitable or not. You have to record. So the recording is the first stage, is the first aspect of accounting. So it's the first process. You enter the transaction into the accounting system. It can be manually, yes, by writing it in there's this accounting record books that you can use, but recently nobody is doing that apart from smaller businesses. But even small businesses, they are using accounting software now. They are no longer doing book, they are no longer in the book era. So the first stage is recording. Let's take note of that. So we are still going to come to that. We have different accounting method as we are being taught, as we are taught in school. We have the cash accounting method, we have the Accrual accounting method. We have the cash accounting method, we have the Accrual accounting method. So cash accounting method, it's when you record your income or expenses when cash is received or paid. And the accrual method is you recognizing your income and expenses when they are earned, not when money actually came into your account, or when money left your account for expense purpose now. So you record it when you earn it, when the goods, let's say you make sales, when the goods has been delivered to the customer, you recognize it. So it can be that the sales has cash has been paid for it, or that was a credit sales. So regardless of whether it's a credit sales or a cash sales, it is being recorded. So that's accrual accounting. You don't wait until you receive cash for every sales that you made, or every expenses that you incur. You record it regardless of whether there's a movement of cash or not. So that's what accurate accounting is about. And it is through the accrual method that gave rise to what we have, what we call the trade receivable. Because in the cash accounting method, there is nothing like trade receivable. I believe we know what trade receivable is about.
Yes.
All right. So trade receivable, also known as our debtors, trade payable. So it is the accurate accounting method that give rise to all of these things. So in summary, accurate accounting method actually give us a broad view of a business. Because if you are only recording when cash is received and when there's a payment of cash, or when cash is being paid, you will not get the true view of that business financially. So that is why in practice the method that is being used is the accrual method, the accrual accounting method. I hope we got that. Please let me see your reaction if we got that. All right. So moving to our next slide. This aspect is very important. Is is very important. We are being taught in school the accounting principles. There are different accounting principles. The entity principle, accrual, matching concepts, prudency, and the rest. So, but there are some particular ones that you must bear in mind as an accountant and when you are preparing your financial statement. There are some particular accounting principle you must bear in mind. So we have the matching concept, right? Also known as the accrual concept. So in this aspect, what this concept is saying, or what this principle is saying, is that a company should recognize revenue. The It said this requires that revenue obtained from a selling for selling a product should be matched with the cost. So when you make sales, the cost that you use, that you incurred in making that sales, should be matched, should be recognized for that period. So what do I mean? Let's assume, using a scenario, a real life scenario now. Let's assume a company makes sales sales, and in making that sales, maybe e ran some advertisement expenses of okay, let's put figure to it. A company makes sales of 200,000 and e ran an advertisement expense on it for 50,000, for instance. So if you are to compute the profit. Okay, all right. Do you have a question, Muturayo?
Now, please, I want you to the Akura machine concept. Please, I want you to recall again.
Okay, yes, I'm still on it. I'm trying to put figure to it so that you understand it better.
Better. All right, ma. Thank you, ma.
All right. So, like I said, you made a company made sales of 500,000. Okay, let's use a lower figure of 200,000, and you ran an expense of maybe an advertisement to make that sales of 50,000. So, if you want to compute your profit, what principle is telling you is that that expense that you made in making that sales, you have to record it, you have to recognize it for that period. So if you had to calculate your profit, it will be your sales figure minus the expense figure, right? Which is 200,000 minus 50,000, which is giving you a profit of 150,000, right? So you have successfully matched the expense of, or the cost incurred for obtaining that sales with the revenue. So let's look, for instance, um let's assume we a customer made sales a customer bought a product of 200,000, right? And that product has not been delivered to that customer, right? Because you only recognize sales. I believe we remember our IFRS 15. Sales is only recognized when it has been what? It has been delivered. You have done your performance obligation, you have fulfilled your performance obligation. So until that product is delivered, you cannot recognize it as sales. Is if it's still in the premises of the company, it cannot be recognized as sales. So if the customer has paid for it but it's still in the premises of the company, it has not been delivered to the customer, you cannot recognize it as sales. So that's one aspect. So let's assume a customer paid for a product 200,000 and an expense has been run for it, an advertisement expense has been run for it. You are not meant to what? Because that product has not been delivered, you are not supposed to recognize that expense for that period. So dis what bring rise to what we have what we call deferred income, and we also have what we call deferred expense. I hope we got that. So we have what we call deferred income, or you can call it customer deposit. So deferred income is a liability to the company because the company has not successfully carry out that sales. So the in the book of the company will recognize it as deferred income, which is a current liability to the company. So until that sales has been fulfilled, it will now be moved from deferred income to what? To sales. And as well, every expenses that is associated to that sales will now be moved from deferred expense to expense for that period. Do we get that? Did we get that?
Yes, ma.
Yes, ma.
All right.
Yes,
So
ma.
what we are just trying to do here is matching your revenue with the cost for that period. You must not take the expense or the revenue for previous, let's say last month, and add it to the expense of this month. So you have the it has to be of the same period. It has to be of the same period. So that's what the matching concept is talking about. So every revenue must be matched with the cost incurred for what? For selling that or for acquiring that revenue. So note, transaction of different periods should not be merged together. Transaction for different periods should not be merged together. So that also bring me to saying this. Let's assume um this same deferred income I just explained now, a customer has paid for it but you have not delivered it. You cannot recognize it as your revenue for that period. You cannot recognize it as your revenue for that period. It has to be taken to the next period when that sales has been fulfilled, right? It has to be taken to the next period, let's say year two. Maybe the goods was finally delivered to the customer in year two. It is that year two that you recognize it in your book, and not year one that the money came into the account. Regardless of whether the money came into the account, you are not to recognize it in your book in year one, but you will recognize it in the year that the sales was completed, which is year two. So I believe we got that. Moving to the second accounting principle, we have business entity. So what this principle is saying is that a company is different from the owner. A company is different from the owner. So we see this mistake among small companies that they will merge, the accountants will merge the expenses of the manager with the expense of the company. So you need to know that this is something you have to go with. The business is different in the eyes of the law, is a separate entity from its director. So if the director is taking money from the business, it can be treated as a loan to the director, or if the company is collecting money from the director, it will be treated as a loan from the director. So there are two different entities. You can't say because I'm the owner of the business, I can spend money from the business. No, you need to clarify, are you taking it as a loan? So in the book of the company, in the company's book, you treat it as director's loan. Or if the company is taking, if the director is giving money to the company, it has to be clarified. Is it a loan? You want us to treat it as a loan to the company, we'll treat it as a loan to the company. Another thing is, you must not classify the director's assets as the company's assets. So what are assets? We have our furnitures, motor vehicles, and the likes. If the motor vehicle is purchased in the name of the director or shareholder, it cannot be recognized as the asset of the company. So for an asset to be recognized as an in the book of a company, it has to bear the name of the company. So this is something you should know, you should bear in mind. So as an accountant, your company wants to buy an asset. Let's say you want to buy a car. It must not be in the name of the director. If it is a company's car, it has to be in the company's name. It has to be in the company's name. So this is something you have to, as an accountant, you must stand on. If this car is for the company, it has to be in the company's name. So why is this important? It's important for tax purpose as well, and because the director and the entity or the company, they are separate entities. So the asset of director cannot be classified in the book of the company as company's asset, and so is the liability. The director cannot go and borrow loan on his in his name and expect the company to bear that liability. So they are two different entity. I believe we got that. Please, do we have any question on that? All right. So if you have any question, like I said earlier, pen it down. At the end of the session, there will be time for question. So and the next accounting principle we have here is consistency, that you need to bear in mind when you are preparing your financial statement, is consistency. So what do we mean by that? There are different accounting methods when it comes to recognizing different let's use depreciation for example. So if your company has adopted, if you as an accountant, you have advised your company, okay, let's adopt straight line method. If you are adopting straight line method, you have to stick to straight line method. You cannot use straight line method this year and use reducing balance next year. So you have to stick to whatever accounting method you have decided, or the company has decided, the management has decided to use. There are different advantages of the different type of depreciation method as we are being taught. So the consistency here is talking about sticking to a particular accounting method. You cannot use one accounting method this year and another accounting method next year. So that's what consistency is talking about. So accounting method is just one of it. There are different we have for inventory. So if a company is adopting the FIFO method, the first in, first out, it has to stick with it. You cannot use first in, first out this year and use weighted average next year. So there are different aspects where accounting methods is. So you have to be consistent. If at a point there is need to change the accounting method, it must be disclosed in the note of the account. It has to be disclosed in the note of the account. So as an accountant, whatever method that you have chosen to use for any of these various accounting, um let's say your depreciation, your inventory, you have to stick to it. You have to be consistent over the years. So users of financial statements, they will be able to compare the previous period with the current period. So that's the essence of it. The next accounting principle is our double entry accounting. Double entry accounting. So for every transaction. Every transaction must have two equal side, right? We have been told that for a debit entry, there must be a corresponding credit entry. So it's also applicable. It's not theory, it's also applicable in practice. For every debit entry, there must be a corresponding credit entry. So you are to debit the receiver and credit the giver, right? So it's also applicable. So every transaction must have two sides, which is a debit entry and a credit entry. So moving to the principle of double entry. Principle of double entry. This is an aspect I would like us to actually listen, because this will actually help us when we are preparing our financial statement. I have to do this so that when we are preparing our financial statement, when we are going to practice, like the practical aspect, we'll be able to understand, like get what I'm every aspect that I'm trying to explain. So knowing these aspects, this theoretical aspect will actually guide us when we are doing our practical session. So the principle of double entry is saying that every accounting transaction has two sides, has at least two sides. Sometimes you can have three, four transaction, three, four accounts in a transaction. Let's use it that way. Three, four accounts in a transaction. So the fundamental rule is that for every debit entry, there must be a corresponding debit entry, a corresponding credit entry. Now, there's this formula that has actually helped me in memorizing the double entry principle. So we have dead and clear. So what does dead means is an acronym. It means debit, expense, assets, and directors current accounts or drawings. Then we have the clear. We have credits, liabilities, income, and revenue. Liability, income, revenue. Sorry, income, that's a typographical error. So income and revenue, they are the same thing. Liability, revenue, and capital. So what does this actually entails? What are we saying? Um what this is saying that debit, expenses, assets, drawings have a debit, they all have a debit balance. So how do we arrive at this debit balance? Let's go to the foundation. Let's assume we have um please, I will need us to speak up on this. I will need to hear from the audience. Let me stop sharing this and go to my Microsoft Word to do an illustration there. Okay, so okay, can you see my screen now?
Yes, your screen is visible.
All right. So let's assume we made a sales. Um, we are looking at debit now. We bought an asset of a company bought an asset. Let's say motor vehicle. Sorry, purchase motor vehicle, which is an asset now. I hope we agree to that. Motor vehicle is an asset of 250,000. So if we are this is a transaction that we need to record in our books, either manually or through an accounting software. So what and they purchase it, let's say by So we have 15 minutes more. Um, okay, I'll try and be fast with this. So let's say they purchase it by, let's say, cash. So cash falls under which category now? Who can tell me? Cash fall under which category?
Category as well. Is it credit or
Okay, so we have different category. We have sorry, can you mute your mic? Sorry. So we have elements of the financial statement, right? We have the revenue, the expense, we have assets, we have liability, we have equity. So these are the categories I'm talking about, or we can call it elements of the financial statement. So where does cash fall into?
asset?
All right. Thank you so much for that. So cash is another asset. Motor vehicle is an asset, but motor vehicle is a non-current asset, while cash is a current asset, right? So now, one is in this transaction, one is receiving and one is giving. One is receiving and one is giving. So our motor vehicle, just to not to waste much time, our motor vehicle is receiving the value, the amount. Our motor vehicle is receiving the amount of 250,000 because the motor vehicle is being purchased by cash by the company now. Why 250,000 is leaving the account or the cash at hand. So cash is giving, right? Cash account is giving. So when at the end of the day, since motor vehicle is receiving, motor vehicle will be what? Debited, because the rule says that we should debit the receiver and what? Credit the giver, right? So motor vehicle will be, I'm just trying to explain how that acronym came about. Motor vehicle will be debited because it's receiving. So at the end of the day, when you want to close your account, you bring your balance carry down to the credit side of motor vehicle account, and the balance brought forward will come to what? The debit side again. So that's why we are saying asset has a debit balance. Asset has a debit balance. Liability has a credit balance. So let's go back to our slide. There's a point I shared there. So hope you can see the slide now. So this is something you can memorize. Assets, expenses, drawings. Let's leave that drawings now. Assets, expenses has debit balance. So whenever you want to increase an asset account, you have to debit the asset account. You have to debit the account. Whenever you want to increase an expense account, you have to what? Debit the expense account. Whenever you want to reduce the account, so if we want to reduce the account, what should we do? We want to reduce the expense and the asset account. What should we do? Let me know if you guys are following. If you want to decrease now or sorry, I didn't get that.
You credit it.
All
Credit.
right.
Credit.
So you credit it. When you want to reduce the expense or asset account, you credit it. So this goes for that's for the expense and assets, and we all know what forms those categories, the different what funds expenses and what funds the assets. Then for the clear, we have credit, liability, income, and equity. So if you want to, what this is saying is that if you want to increase your liability account, your income account, your equity account, you have to credit it. So if you want to reduce it, maybe there's an error in your posting and you want to reduce that account, the journal you are to pass is to debit the liability account and credit whatever account that is affected, any other account that is affected. So to increase your asset account, you debit it. To reduce it, you credit it. And to increase your liability account, you credit it. To reduce it, you debit it. So if you can remember, dead, debit, asset, expenses or expense assets, then clear, credit your liability, income, and yes, your liability, income, and revenue. They're supposed to be equity, actually. So do we get, did we get that? Let's, before we move to the final aspect, then we'll take some questions, like two, three questions, because we are short of time already. Can I continue? All right.
Carry.
So the last aspect of this session is the four major statements of the four major statements in the financial states. The four major statements, yes, in the financial statements. So we have the income statement, or what we know as the statement of profit or loss. So what the statement shows is whether the company is making profit or loss, right? It shows the revenue earned and the expenses that was incurred during a particular accounting period. So most companies, their accounting year end runs from January 1st to December 31st. Majority of the companies. There are some that have some other accounting dates, but 80% of companies, their year end starts from January 1st to December 31st. So within this period, you recognize all the revenue that came in and the expenses. But that does not mean most companies, they do require their accountants to prepare monthly reports. Yes, you can prepare monthly statement of profit or loss, monthly statement of financial position, cash flow. So most companies, they want to know what are they making profits on a monthly basis. So they don't want to wait the year end before you prepare their financial statement. They call that management account. So it is called management account. So you prepare their statement of profit or loss on a monthly basis. So we have statement of financial position that shows the assets owned by the company, the liability, and whatever income that the owners of the business brought into the business, which is the equity, right? So we also have statement of cash flow. Statement of cash flow, it shows, your statement of financial position, your statement of profit or loss, they are on accrual basis. They carry, you see debtors, trade, credit sales, and the likes. But your statement of cash flow is showing just the cash transaction. So every accrual basis is, you can't get it in the statement. It shows the cash position at the end of every period. So it takes out accrual basis and bring out the cash aspect of it. So we are short of time already. So tomorrow we are going to be learning how to prepare financial statements on Excel with incomplete record. So I will not speak much on that because we are short of time. But so I would like to take question. Do you have any question, anything during, maybe between the training and that you don't understand and you want clarity on? Okay. So do we have question?
There is a question on the chat box, please.
Okay, I think my network is. Oh, I can't see the question. I can't see the question. Can you type or you can just speak up if you can?
Okay, let me just ask it.
Okay, okay. I think I've seen it.
Okay.
So if the company owner has already put his assets purchased in his name like car and furniture into the business, and how can we convert it to the company's assets? So this cannot be converted because now you have purchased the asset and you have been given a receipt. So when we are saying it has the director's name or the company's name, it's through the receipt that was given to you when you purchased the asset. So if a receipt has been issued, you cannot go back and change it. So it has to, if it's in the director's name, it has to stay like that. It's not the company's property, it's the director's property. But if it's in the company's name, if that's in the receipt now it is bearing the company's name XYZ, then it can be captured as the company asset. I hope I have answered that question.
Yes, thank you.
Or Femi, have I answered your question? Please let me hear from you. You can type or you can react. All right, do we have any other question? Does anyone have any other question? Okay, in the absence of no question, see you guys tomorrow, same time by 8 p.m. And this video will be uploaded on our YouTube channel. You can go back and watch. Thank you so much for the upload. Thank you. Hope to see you guys tomorrow, same time. For now, bye and remain fantastic. See you tomorrow.
Thank you, ma'am.
Thank you, sir.
Thank you.